Hey folks, this is Shawn Plummer over at the Annuity Expert. Today we're going to talk about what happens if I own an annuity and I die. What do my beneficiaries get? Today we'll go over the different types of annuities that are out there and the different scenarios, ways that you possibly could lose a death benefit and ways you can actually boost your death benefit for your beneficiaries as a life insurance alternative. We'll start with the annuities where you may not have a death benefit and you kind of get hosed by purchasing the wrong annuity. That is with the immediate annuity, okay? Or otherwise known as the single premium immediate annuity, or SPIA. A lot of big box brokerage houses sell these SPIAs, and what you have to understand is if you choose the wrong payout in a SPIA, there could be little or no death benefit. Let's give you some examples. With a life-only payout, so it's not life of period certain, it's not joint and survivor, it's just single life-only payout. You're basically giving all of your money to the insurance company for the highest payout, and the trade-off is when you die, whether it's tomorrow or in 40 years, the insurance company keeps that money that you've given to them. We rarely recommend doing that, and in the examples that we do recommend a life-only payout on an annuity, we always recommend to get an affordable life insurance policy to make up for the cost going into that SPIA. So for example, if you bought a $500,000 SPIA because you want the highest payout, we say, hey, go out and buy a term life insurance policy for X amount, 20, 30, 40 years for $500,000, so that in the case that you get hit by a bus tomorrow, your beneficiaries will inherit that original $500,000 that you're putting in, and then at most you may pay a couple $100s a month for that, right? So life only payout, single life only payout on a SPIA equals no death benefit. The next one we're going to talk about is the joint and survivor payout on a SPIA. Joint survivor SPIA basically says, hey, we're going to pay you X amount of dollars for the rest of your life, and then when you die, your surviving spouse will get that same amount or a lower amount, typically 75, 50% of what the original amount is for the rest of their lives. So in this example, you get paid $10,000 a year for stupid math. You get hit by a bus and your wife has a 50% survivorship. She's gonna get $5,000 for the rest of her life. And then when she dies, no death benefit to children. Third one is the single life with period certain payout. And basically what that is it'll pay you a payment for the rest of your life, and it'll have a guaranteed window that beneficiaries can receive a death benefit. Okay, so in an example of life with 10-year period certain, and it paid you $10,000 a year for the rest of your life, for stupid math, and you died in year 2, your beneficiaries will continue to receive the same $10,000 in year 2 to year 10, and then after the 10th year, no more death benefit, okay? So you're kind of putting a level of protection for your beneficiaries in case you die for some odd reason. The next payout is life with installment and life with cash refund. These kind of work the same way, just in the frequency of how you get paid out at death. So if you get life with installment, you basically get paid a fixed payment, and then whatever is left of your original investment, it'll pay you out over installments, or pay your beneficiaries in installments at the time of your death. If you have cash refund, it'll just pay you whatever the remainder of your initial investment was in a lump sum. So for example, you put $100,000 into a SPIA with an installment refund. You die after 1 year and your payment's $10,000 a year, stupid math, and you have $90,000 left in the beneficiaries. Your beneficiaries will get that remaining $90,000 over the installments that is dictated in the contract. If it's cash refund, same beneficiaries will receive the remaining $90,000 in a lump sum. Why this is important is these type of terms and conditions in your contract that you're buying dictate how much money you will get paid, okay? So if you want the highest, you're taking a huge gamble, just buy life insurance, and it continues to go down in payment when you start adding some guarantees into your contract. So that's SPIAs. That also applies to if you have a deferred annuity and you annuitize it, which we don't recommend if you can get a lifetime income rider. If you annuitize, same deal. If you have a pension and you choose the monthly benefit, well, the pension's using an annuity. You look at the thrift savings plan the government uses for their federal workers. If they choose the monthly payout as an alternative, If they choose to do the monthly annuity payout instead of the lump sum payout, what's going to happen is the federal government takes your thrift savings plan, they roll it into a MetLife SPIA, and those SPIAs have those type of payouts. Just be aware of how those work. If you choose to use a private, individually owned deferred annuity and you choose to have a lifetime income rider, or you don't, and you die, your beneficiaries as a standard will receive whatever is left in the annuities contract in a lump sum or a series of payments depending on contract to contract. So in most cases, you could sleep at night knowing that, hey, I bought this long-term contract. If I get hit by a bus tomorrow, my wife or my husband and kids are going to receive whatever's left in that annuities account in a lump sum. Some things to know about that: there are a very small sliver of annuities out there that put in these, what we call gotchas, which says, hey, if you die before the term's up, we're not going to give you the account balance in a lump sum. We may give you the cash surrender value, which is basically your account balance minus a surrender charge because you died prematurely. So you always want to check your contract before you buy, because sometimes these are these hidden terms that you see from all these other yahoos on YouTube saying that there may be. The good news is it's a very, 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 very tiny pool of annuity products that offer that gotcha. So always be on the lookout for that. The other thing is enhanced death benefits. So there are, once again, a very, 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 very small pool of annuity contracts that have what's called enhanced death benefits. And these are basically life insurance alternatives. So you can't get life insurance because of a pre-existing medical health condition, or you're terminally ill. These enhanced death benefits, basically what we'll do is what it says: enhance your death benefit to your beneficiaries. And so instead of getting whatever's left in the account balance, your beneficiaries may have the choice, and that's the key word, choice, of either taking the standard account balance in a lump sum, or you can get this enhanced death benefit, let's say paid out over 5 years. I'll give you an example. Annuity owner purchases a particular annuity with this enhanced death benefit, and the enhanced death benefit gives you a 50% bonus that could be accessed via a death benefit, and you die tomorrow, get hit by a bus. Your beneficiaries will have the choice of taking the original investment, let's say it's $100,000, in a lump sum, free and clear, and go on with their lives. If they're a spouse and they don't want to pay the taxes because they're afraid they're going to get into a higher tax bracket, they can say, hey, I want to exercise the spousal continuance provision and continue the contract and continue to defer the taxes. Or they can take the enhanced death benefit, and in this example, it's a 50% bonus. So that $100,000 that you put in there is worth $150,000, and they could take the $150,000 paid out over a 5-year period. And I think that's a great thing, because if you're in a certain tax bracket and you inherit a large amount of tax deferred money that you have to pay taxes on, it could bump you into another tax bracket and screw up your whole financial environment. So there are those options as well that you can do. As far as any other annuities go, it's going to be the standard lump sum down to your beneficiaries. But always ask whomever you're buying an annuity from what those are, because you may have a hidden term that you're not aware of. You may have a benefit that you're not aware of that could benefit your beneficiaries in the future. And if you just want to talk to somebody about who knows about enhanced death benefits and ways to get the most bang for your buck for your death benefit, or you're looking for a life insurance alternative, contact the Annuity Expert. We're licensed in all 50 states. We have the largest selection of annuities in the United States, and our goal is to get you from point A to point B with the least amount of money and get the most bang for your buck. Hope you enjoyed this video. Like, subscribe, so we can get in front of more people. Please contact us at the Annuity Expert, and we'll help you out going forward. Have a good one.